All right, guys, let us continue with the question number one of March, June 2021 exams. And here is the another requirement which we have to look at, and that is evaluate the audit risk to be considered in planning the audit of PL company, and we will get 20 marks for it. And as you know, we already discovered our few audit risks. First of all, a new audit client of our firm, and secondly, that company is seeking to achieve a stock market listing in the next 2 years, right? So straight away, our worksheet now, and B part, audit risks, new client. This is the first year in which chief and company has audited the company, which increases detection risks, as our firm does not have experience with the client, making it more difficult to detect material misstatements. Additionally, there is a risk that opening balances and comparative information may not be correct. The prior year figures were not audited, were not audited by chief and company. Therefore, we should plan to audit the opening balances carefully to ensure opening balances and comparative information are both free from material misstatement. Bang on. Then here we get 2 marks, and let us move uh, to the other part. Now here we will have some part related to internal audit. And what's that? As you can see, PAL company has small internal audit department with 2 staff who report the company's CFO. As a company does not have an audit committee, blah blah blah. Move on. This part is related to whom corporate governance, right? So we have some weaknesses in it as well. So let us discuss about it. Okay, we will also get marks for it. Okay, corporate governance. The company does not have to comply with corporate governance requirement as it is not a listed entity. However, it is good practice to have an established audit committee, especially for a large company like Pale Company, which is seeking a stock market listing in the near future. The internal auditing is small and is small and lacking in independence as they report directly to the CFO. This means that the scope of their work is likely to be quite limited due to insufficient resources and any recommendations made could potentially be ignored by Mark York. This has implications for controls over financial reporting, which could be deficient and increases control risks. There is a high scope for errors in financial reporting processes and for deliberate manipulation of balances and transactions as the internal audit team does not have sufficient resources for thorough monitoring and reporting. Bang on. Let's move on. Okay. Then further we have one more thing which we can discuss as such, that is pressure on results. Okay, pressure on results. The company is not a listed entity, but the existing and new shareholders will be looking for a return on their investment in the form of a dividend payment. In addition, in the run-up to a potential stock market rotation, there will be pressure for the company to show good financial performance. The company also has ambitious international expansion plans. Okay, so pressure to return a better performance. Better performance create an incentives for management bias, which means that management may use earnings management techniques or any other methods of creative account to create a healthier picture to create a healthier picture of financial performance than is actually the case, which creates the inherent risk and inherent risk of material misstatement at financial statement level. Cool. Then let's move on. Accounting policies. Mark confirm Pale Company applies the requirement of IS 41 agriculture as follows. Standing timber, which means trees which are growing in the timber plantations prior to being felled, are biological assets measured at fair value less cost to sell. The change in fair value less cost to sell is included in profit or loss for the period in which it arises. Okay, that's fine. Felled trees are agricultural produce which are measured at fair value less cost to sell at the point of harvest. Immediately after felling, trees are processed so that the value of the felled trees awaiting processes is minimal at any point in time. Okay. Processed timber such as logs are measured in accordance with IS2 inventories. A technical expert from the audit firm has confirmed that the accounting policies outlined above appear appropriate in the context of Pale Company's activities. Okay. Right. Now, move further. Let us move further. The Pale Company operations are currently all based in home jurisdiction. However, the board has recently approved the acquisition of several large areas. Developing the expansion will show the acquisition of the areas of the rainforest will cost 25 million, and the purchase is due to take place 25 million equivalent to the farmland as the same. Okay, okay. Do you think this? Do you think that there is any uh, audit risk here? No, no audit risk. So move on. The purchase is being funded through a share issue to existing and new shareholders who are mainly members of the Pale family. 20 other share issue was only option of finding the international expansion. And International Development Agency had agreed to provide a grant of 20 million to assist Pale in Farland expansion on condition that the expansion represent sustainable and ethical business practice. The grant is provided specifically for training local workforce and building accommodation for the workforce in the town near to the rainforest. The grant is due to be received in September. Relevant expenditure will commence in November X5. Okay. Mark York is planning to recognize half of the amount received as income in this year financial statement. On the basis it will cover some of the management expenses in planning the international expansion. Okay. Okay. Let's dive in now. Government grant, our next one. So far, we earn 4 marks, and that will help us getting 3 marks more. So that will be a 7. Government grant of 20 million has been awarded to Pale Company. This amount to 3.6% of total assets and is material to the projected statement of financial position. Mark York has suggested that he will recognize $10 million of the amount received in profit for the year projected profit before tax is only dollar 6.5 million. So increasing the profit by this amount would be highly material to the statement of profit or loss. The audit risk relates to whether this should be recognized as income in the current accounting period. Okay. IS-20 government grant uh, requires that government grants are recognized in profit or loss on a systematic basis over the periods in which the entity recognizes expenses for the related costs for which the grants are intended to compensate. Mark York is planning to recognize expenses for the related costs for which the grants are intended to compensate. Mark York is intended, is planning to recognize half of the grant as income this year. However, however, this is not expansion. So the appropriate accounting treatment. So the appropriate accounting treatment would seem to be that the entire amount of the grant is specifically provided has not yet been incurred. Therefore, there is a risk that company will recognize the income too early, leading to overstated profit and understated liabilities. Okay. Further, let us move to the other part and let us see what we can find for the further part. Nothing in gold standard regarding the audit risk. Move on, move on, move on. Contract with Royal Company, nothing. Then group of the employees has recently commenced legal action. Company claiming the breaches of health and safety guidelines regular take place. The company has made some redundancies these year. So IS 37, which has put pressure on remaining staff to work harder in order to avoid accidents, so some of which have resulted fatalities. The company management and legal advice believe that the legal claim amounts to 19 million, is unjustified and will not be marked, or does not intend to recognize a provision for claim or make any disclosure in the financial statements. So that's related to IS 37, and it will understand a liability, right? So move on. Legal case, very simple one. Legal case. The legal case would give rise to a risk of understated liabilities or inadequate disclosure if the company fails to provide for the $19 million claimed by employees or to disclose the matter as a contingent liability. It is, sorry, it will be a matter of significant judgment to decide whether the legal claim is likely to go against fail company no, or not at this early stage. However, the matter is material at 3.5% of total assets and being close to 3 times projected profit for the year. Therefore, warrants careful consideration. Right. So, therefore, due to its sensitive nature, the auditor consider the issue to be material by nature. Okay, bang on. Another one, 3 marks, and we get 10 overall. Now, we will move ahead in the scenario, and come on, let us look at it. Yep. Use of expert change in fair value due to recent storms in the last month. Several uh, storms caused damage to some areas of timber plantation. Timber plantation. Okay, what's it saying further? Yeah. An independent has been appointed by the management to determine the extent of damage caused and to quantify any financial implications, including determination of the road and fair value of the standing trees, which have been damaged by the storm. The expert's report indicates large number of trees have been completely destroyed and many have been badly damaged. Based on the expert report, management has determined that a reduction in fair value of 75.5 million should be recognized in respect of the timber plantation asset recognized in SOFP, Statement of Financial Position. Okay, so next item, reduction in fair value of timber plantation. The company's timber plantation asset prior to recognizing any change in fair value is projected to amount to 90.9% of the company's total assets and is therefore highly material. The company has correctly obtained an expert's opinion. An expert's opinion on the change in fair value of the destroyed and damaged trees caused by the storm. The expert's valuation has helped management to determine that a reduction in fair value of $70.5 million should be recognized in financial statements with profits. Okay, this amount is material in its own rights at 14.1% of the timber plantation. Asset and being more than 10 times projected profit and being more than 10 times projected profit. When the losses in value is recognized, it will turn the projected profit into a significant loss. There is a risk that management will not recognize the loss in full due to the impact it will have on profit. This is therefore a very significant issue for the audit planning. Further, there is a risk that expert valuation is not appropriate if the expert does not have appropriate expertise to perform this specialist valuation, which would lead to issues in whether the valuation can be relied upon. Right. So done with this one. Next, move on. Uh, let's move on and let us look at the related to. We have looked at the revenue, profit, PPT, timber plantations, number of employees already discussed. Now, inventory, 15.4% million this year. Last year, 9.2 million. Increased level of is explained by the management as follows. In last 2 months, the industrial action at the country's profit made no containers of processed timber shipped to our export customer. The Mesa export sales so far about 2.1 million. We continue to harvest and process timber during this time, leading to an increased level of inventory, blah, blah, blah. Okay. So move on. Next part, inventory. Inventory and yeah, the level of inventory. What am I doing? Inventory has increased significantly by 67.4%, and the value of inventory at 30th June 2005 represents 2.8% of projected total assets. The inventory is therefore material to the financial statements. There is a risk that if the industrial action continues and the company cannot fulfill its export sale contracts, the customers will cancel their orders. The inventory then may not be saleable to other customers. Perhaps if the timber has been cut to customer specification or requires modification to secure a sale to a different customer. Okay. According to IS2, inventories inventory should be recognized at lower of cost and net realizable value. And there is an audit risk that inventory is overstated if any necessary. Write down to net realizable value is not recognized. This would result in overstated current assets and overstated profits. All right. One more issue, which mostly students may be not able to recognize from the scenario, is related to going concern. My last point. There are several indicators that despite its projected increase, in revenue and profit, the company faces going concern problems. These indicators include but are limited to operational problems, including the destroyed timber plantation and industrial action, reputational damage caused by the legal claim and possible legal payment. Financial problems caused by lack of cash and the fact that its results are likely to be much worse than that projected by management when the decrease in fair value of the destroyed timber plantation is taken into account. Okay, so here IS1 requires that management provides a note to the financial statements which discusses any material uncertainty over the company ability to continue as a going concern. If management fails to disclose this note or provides the note but inadequate detail than the requirements of IS1 have been followed, creating a significant audit risk. So that's it for this part of the requirement. That's how you should have draft the answer for this part of the question. I hope it's clear now, and I will see the next session with the audit trust principle or the procedures. Till then, take care. Ta-da!